Hey everyone, welcome back to Corporate Decoder. Today L.O.K.V.U just filed an 8K reporting an extension of their merger deadline, and I'm seeing one detail that tells us they really need this deal to close. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company needs more time to get its big deal done, and that deadline extension hints at some serious hurdles. This is an update on a deal live L.O.K.V. acquisition Corp V, or L.O.K.V.U, as it is known on the stock market, has been working on. They are trying to combine with a company called Teamshares. Think of it like a SPAC, a special kind of company that goes public with the main goal of buying another private company. The original deadline for this merger, the date by which the deal had to be completed, was May 1st of 2026. This filing tells us that on that very day, May 1st, L.O.K.V.U and Teamshares agreed to push that deadline back. So now the new deadline is the 15th of July 2026. This isn't just a small tweak, it is a significant extension. Why do they need more time? Usually it is because there are still things to sort out, like getting all the necessary approvals, or maybe sorting out financing, when deals get this close to the wire and need extensions. It often means there is more complexity than initially planned. Let's look at what live L.O.K.V. is actually made of. They have these units which are like a package deal. Each unit contains one regular share of stock called an ordinary share, and then half of a warrant. Warrants are basically options to buy stock later, and in this case, they are redeemable. These units trade under the ticker L.O.K.V.U. Then there are the regular shares themselves, which trade under L.O.K.V. These are Class A ordinary shares with a very small par value, which is a nominal value assigned to the stock. And finally, the warrants, which trade under L.O.K.V.W. Each whole warrant lets you buy one Class A ordinary share at a price of $11.5. These different pieces, the units, shares, and warrants, are all listed on the Nasdaq stock market. The fact that they're extending the deadline suggests they haven't met all the conditions to close the deal yet. This could involve getting shareholder approval, which requires a lot of communication and voting, or perhaps clearing regulatory hurdles. Often, SPAC deals face challenges in the final stages as they work to bring something complex to fruition. This section shows that this filing is also being used for written communications related to the deal, meaning they are likely sharing important information about the merger with potential investors. Live Oak has checked the box indicating it is an emerging growth company. This means they have certain regulatory and reporting flexibilities, like being able to use extended transition periods for accounting standards. This is common for newer public companies. This part of the filing is where they detail the actual event, which is the extension. They mention the original agreement, the merger agreement, which was first signed back in November of 2025 and has been amended since then. The key point here is the original outside date, May 1st, and the agreement to pushing it to the 15th of July. This gives them roughly 10 more weeks to finalize everything. Now, let's consider the implications. When a SPAC needs to extend its merger deadline, especially this late in the game, it can put pressure on the stock. Think about similar situations where companies, especially smaller ones, had to extend deadlines for their SPAC mergers. Often these extensions signal that the deal is facing difficulties that could even lead to the merger failing. For example, after Sears underwent multiple reverse stock splits and extended deadlines, it ultimately filed for bankruptcy. While not a perfect comparison, the pattern of needing more time and facing complexities can be a warning sign. The filing also points to where more information can be found. They filed a registration statement which includes a proxy statement and prospectus. This is important information for Live Oak shareholders who will be voting on the merger. It is where all the detailed terms, risks, and financials are laid out. They encourage shareholders to read these documents because they contain crucial information about the business combination. You can find these filings on the SEC's website, which is the US Securities and Exchange Commission. This part is a strong reminder that this announcement is not the final word. Shareholders should do their own research and carefully review all the official documents. This section explains who might be considered participants in soliciting votes for the merger. It includes the directors and officers of Live Oak and Teamshares. Their interests might be different from those of regular shareholders, and this information will be detailed in the proxy statement. This is a standard legal disclaimer. This report is not an attempt to sell you stock or convince you to buy stock. It is just providing information as required by law. And as with most public company filings, they include forward-looking statements. These are statements about the future, like plans and expectations, but they come with a big warning. They say that actual results could be very different from what they expect. They list many factors that could cause actual results to differ, such as not being able to complete the business combination, failing to get shareholder approval, or issues with keeping their stock listed on an exchange like Nasdaq. The big takeaway here is that extending the merger deadline is not usually a positive sign. It indicates that the parties are struggling to meet the conditions necessary to close the deal. This This could be due to a variety of reasons, including lower than expected shareholder support, regulatory challenges, or simply the complexity of integrating two companies for investors. An extended deadline means uncertainty. It means the eventual outcome of the deal is less predictable. If this deal were to fall apart, we've seen SPACs, especially smaller ones that go through post-merger periods, experience significant stock price drops. For instance, some SPACs have seen their stock price fall by 70 to 90% in the year following their merger if they were under a certain size cap. This extension to the 15th of July while giving them more time also keeps that uncertainty hanging over the stock. The key risk here is that the deal might not close at all. And finally, the report is signed by Richard Hendricks, the Chief Executive Officer of Live Oak Acquisition Corp. V, indicating the official filing. In conclusion, this filing is all about delaying the inevitable, or at least postponing the final decision on this merger. The extension to the 15th of July for Live Oak and Teamshares is a clear signal that the deal is facing hurdles. While they've been granted more time, it raises questions about the deal's ultimate success. The risk I am watching is whether they can overcome these final obstacles, or if this extension is just kicking the can down the road before a potential deal collapse. What I am actually looking for is clarity on what specific conditions are still not met. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.